Hello and welcome, everyone. It's great to have you back here on the Catholic Money Mastermind podcast. I'm Ben, your host, and I'm joined today from another co-advisor and part of the leadership team, actually, here within the Catholic Financial Planners Network, to discuss a financial topic that was new to me. So I'm actually going to be here on your side, asking Mike questions related to this because he's kind of piqued my curiosity. And it's something that I've kind of known about, but I haven't seen it firsthand. Mike suggested that we should go over it together, and I thought, what a great idea. So in case you're curious, what are we going to be talking about? We're talking about how to tap the investment values, the equity in your taxable brokerage account, which largely sits kind of unusable unless you go to sell the assets. Like, that's how it feels. Like, the only way I can get money out of this account is if I sell some of my investment positions, and then I've lost that position. It turns to cash. I can take the money out, but then it's no longer invested. What Mike's going to propose to us today is a way to tap that money. So looking forward to having that conversation with Mike. We'll also discuss some other ways maybe to tap retirement accounts or other investment wealth accounts that you may have available to you, but wanted to really lean into this whole notion of tapping your investment brokerage accounts. So Mike, thanks for being on the show.
Thanks for having me here again, Ben. I greatly appreciate it. Looking forward to this conversation.
Absolutely. Well, Mike, you always share a lot, and the audience gains a lot when you're on the podcast. So it's great for us to have you back. So the issue here is, like, typically with money held in an investment brokerage account, and again, this is a little different from like a 401k, an employer retirement account, or an IRA. And we could speak. There are ways maybe to tap that money, but like an investment brokerage account is like really a no fanfare way to invest. We're putting money into an account, we invest it. Tax-wise, though, which is kind of the deciding factor on a lot of these accounts, there's no preferential treatment given to the account, as dividends or interest, are generated from the investments. As we have capital gains from the investments, that money is all subject to income taxes on a year-by-year basis, and so naturally enough, we might have some appreciated assets within the account, and maybe things have gone really well. We have really significantly appreciated assets in the account. And we don't want to really sell those assets because, doing so will produce a taxable event, which shows up on the tax return. And now we got to pay taxes, due to the money that we've made. So Mike, what you're kind of proposing, this idea that we could kind of have our cake and eat it too, if you will, where we can, keep these appreciated assets, not actually sell them, allow them to stay invested, but still get cash out of the account. Like, you're going to have to just share and tell me a little bit more.
Yeah. So, whenever we're designing a financial plan for an individual, family, or retiree, or business owner, we're trying to take an audit of what assets do they have and where they're located. And we label them very elementary, right? In the sense of, short-term buckets, mid-term buckets, long-term buckets. I like to think of the taxable brokerage account as a mid-term bucket or even an opportunity fund. In my mind, it's additional liquidity on your balance sheet before age 59 and a half, which is a triggering year when most retirement assets or qualified assets become available without early withdrawal penalties of 10%, right? With an asterisk next to like a Roth IRA, since return of basis is available from a Roth IRA standpoint before age 59 and a half. But the idea of the brokerage account in my mind is that, hey, these are additional liquid funds that I am hoping will generate a greater return than what I can yield in a high yield savings account or in a CD, right? Taking on a little bit more market risk, equity exposures, in return, hoping that you're going to receive, 6, 7, 8, 10, 12% returns in any given year, depending on how you're invested. Now, traditionally, if you were going to go and buy a car, or if you were going to put a down payment on a home, and you were going to pull those funds from a brokerage account, you would have a triggering taxable event, right? And it's going to come down to how much of your portfolio did you sell, what value did you sell it at, and what was the overall basis or the original principal value of the assets that you sold. You touched on that a little bit, where you would fall into either short-term or long-term capital gains, and this isn't a conversation focused on taxes, but there's different tax tables for each, right? Ordinary income for short-term capital gains, and then for long-term capital gains, I believe it's 0%, 15%, or 20%, then depending on your household or your household's modified adjusted gross income, right? For single file or married filing jointly. Well, I like to think of it of, okay, well, what am I giving up by disrupting where this compounding effect is occurring in this portfolio, this account? If I were to sell these investments and go buy that car, or sell these investments and go put that down payment on a home, or sell these investments and buy into equity ownership in a business, how long would it take me to replace those funds after the fact, right? With this new purchase or investment that I'm making. Well, what if there were a way that I could access equity in my portfolio, right? The growth between what I invested and where it's appreciated to today without triggering a taxable event. Well, you can do that. It's through what's called a securities-backed line of credit, or a SBLOC for short. And effectively, it's very similar to a home equity line of credit. You have the value of the account, and the firm or the lending institution who's going to put the lien against your investment portfolio will give you somewhere between, in my experience, about 60% to 90% of the portfolio value in an accessible line of credit. Now, what's really neat
Mike,
about
just
these,
to step that back a little bit. So you were saying as high as 60 to 90% loan to value is what they're willing. So what kind of institutions? Because I would say most conventional lenders would be like, whoa, wait a second, we're going to. Because the issue with equities compared to, equities, we call that securities, that's investments. These are kind of fancy names for ownership within, publicly traded companies. There's the concern of speculation and that the company might become worthless and not turn into anything, and there's always a financial risk in terms of the future of any of these organizations. We have a higher degree of security in terms of, homes or purchasing properties, and people are more likely to go and buy a house. So as collateral, we're not as concerned, or most lenders aren't as concerned. So they're willing to lend a rather generous amount. So like a 60 to 90%, loan to value is like, wow, they're willing to take on a lot of that speculation risk. Is there could you just maybe share a little more? To be honest, I'm a little surprised that there would be as much of a willingness to lend on that.
Yeah, so just to clarify further, a lot of that's going to be dependent on the makeup of the portfolio. So if you own 100% individual stocks, they may only be willing to offer you 60 to 65% loan to value, right?
Sure.
Because to your point, there's going to be more probability of, or potential for, market turbulence, right? Variability in the portfolio value year to year. Now, if you own bonds or vehicles that are more conservative in nature, they'd be willing to likely offer you closer to the 80, 85, 90%, right? Depending on the institution. The provider that we've had most experience with is going to be Supernova through Asset Mark Trust. They're a third party that we've been working with and have had very good experience up to this point. And again, clients who have portfolios that are predominantly comprised of bonds and others were predominantly comprised of equities, giving us that range of about 60 to 90% portfolio to loan value.
Sure. And I suppose that would make sense just as a matter of a stability of an asset, unless we have defaults with bonds. Bonds, we're going to have a return of principal plus interest payments. Don't see as much, market volatility related to the, asset price. Whereas stocks, something could be worth hundreds of dollars per share and then potentially drop to $10 per share and maybe never recover in that valuation.
And that brings up a good point. I would say that's where you have to understand, at least do some research on, okay, well, what are the cons of getting this established? Well, if I have an outstanding line of credit, one of the things we haven't talked about yet is that there is interest that is applied, right? Sure. If someone is lending us money, there's typically an interest rate associated with that. And in my mind, the interest that's being applied is really just the cost of retaining my asset and not having a taxable event. It's still getting access to the capital, right? But if the portfolio value comes down or drops in a severe manner because of market turbulence, and you breach the margin call threshold, well, that's where you, as the line owner, the line of credit owner, the portfolio account owner, would be required to come to the table with a large balance to either pay back the loan or pay back a large portion of the loan to bring it back into a reasonable range of what's outstanding versus what was available to you. So you don't, another way of saying that is you don't want to get upside down in your loan to where the portfolio value is actually less than what's outstanding from a line of credit standpoint.
Yeah, now you've got that proverbial margin call, right? Which in a lot of the work that we do, we don't normally work in margins, so we don't thankfully have to come to those margin calls. But this is an issue, just as a point of clarity for everyone listening, if you're not familiar with these concepts, that ultimately you can take these loans, but the lenders do, their intent is to make money on this, and they'll do that through the interest cost. But ultimately, if the loan to value starts to get too lopsided, they're going to say, hey, if you want to continue to keep this line of credit, you're going to have to basically come out of pocket and give us more capital as a a way to basically make us feel good about where we stand financially and allow this to stand. Otherwise, we're going to close out your position, and you may be forced to sell the assets, perhaps if we're dealing with like a market downturn and they're at decreased asset values, maybe at a loss, in order for them to get their money back out of the deal. So that would be, for what it's worth. I'm glad you brought it up, Mike. I mean, that's a potential concern in this arrangement, is what kind of volatility do you have the portfolio, and could we have enough of a loss that would trigger a margin call? But let's presume that we're working with relatively stable assets, and there's not a lot of volatility, or maybe we're primarily invested into bonds. What's to love about this is it's an opportunity to stay invested, to continue to maintain and hold your positions, not incur a taxable event, and still use the asset at relatively low cost. Mike, do you mind maybe just sharing, like, what would someone expect? I mean, it sounds like you could maybe potentially pull quite a bit of the value out through this loan, as much as 90%, which it seems like a very generous limit, honestly. But what kind of cost would someone pick up if they wanted to go this route?
Yeah, so I can only speak to our provider, but for our provider, we can look at establishing a line of credit with a line size of about $25,000 and up. So if you have a line of credit of $25,000 up to about $250,000, the interest rate is actually associated with the 1 month SOFR rate, which is different. Most loans, like a home equity line of credit or even a 401k loan, are going to be associated with the prime rate. So most people are familiar with that. But in this case, it's the 1 month term SOFR rate plus some sort of margin. So in this case, the lowest line of credit available is going to be the SOFR plus 2.9%. While the 1 month SOFR as of today, June 17th, 2026, is about 3.639%. So you would then take 3.639 plus 2.9, and you end up with a rate of about 6.539%, which is a relatively attractive rate in comparison to the prime rate. I think the prime rate right now is around 6.75%. So if you were to take that same loan from your 401k, it would be prime plus 1 or prime plus 2. If you're going to do a home equity line of credit, it might be prime plus 0, or it might be prime plus 1, similar to the 401k. So it really just depends. And ultimately what we're doing is we're shopping interest rates, right? The other neat thing about setting up the securities-backed line of credit is that there are no closing costs. So if you're going to go set up a home equity line of credit through a credit union or a bank, there's typically going to be some form of closing costs associated with it for the attorney fees that are that come along with establishing the line of credit against your home. So in this case, there's typically no cost to having it established other than a credit pool for you and your spouse if you're doing it on a joint account.
Sure. So these are good questions. We could go into more of that loan detail. What I heard from you, Mike, is like, look, the loan cost just depends on the overarching economy and what market rates are, and they're going to have a markup in their numbers because they want to make money. But maybe presently you could be expecting to pay 6 to 8% in interest charges. Am I interpreting that right? Just so we can land on a number somewhere, let's call it 6 to 8%. Would it come higher?
So and again, I would say if you're looking at securities-backed line of credit, it could be as low as about 5.25% up to about 7%. Now these rates are variable, but a lot of that is going to be indicative of how big of a line size you have, right? A line of credit you have. So if you have, let's just say, a $5 million individual account and you're setting up a line of credit and they're giving you access to about $3 million in line of credit, well, it's going to be the SOFR rate plus 1.9%. If your line of credit's only $100,000 because you have a $500,000 account, then it's the SOFR rate plus 2.9. So it's going to scale downward as your line of credit value gets higher.
Sure. And again, that makes sense. Most lenders, this is just true of the economy as a whole. The more you do like a bulk arrangement, the better the sort of deal of discounting that you see on the bulk. And so the lenders like, hey, if you're going to give us more more collateral will give you a sweeter deal. Which I'm sure there's a lien on your investment accounts, and then the lender has rights to force some sort of transactions so they can protect their position. Obviously,
Correct.
we'll need to go over the fine print and any of these considerations if this is something you're wanting to kick around for yourself. But I am kind of curious, Mike, how does the loan itself tend to get structured? Because is there with like a HELOC, as they're called, a home equity line of credit, you tend to have like a draw period of 5, maybe 10 years. In which you could pull, money out from the line of credit with, again, the house as collateral. And then, the lenders kind of like to see you keep making payments to make sure that you're good for the money. So even once you pull that money out, you have to start making payments from day one. And then we have to figure out, well, what kind of payments do you have? And so you have an amortization table. And so, with these sort of arrangements, like, is there an undefined draw period in terms of how long you can pull the money out before the line of credit closes or has to be renewed? And then what kind of amortization would we be looking at?
Yeah, so I would say that's probably one of the most attractive things when it comes, or characteristics that when it comes to the securities-backed line of credit, in my personal opinion,
Sure.
is that there is no specific time frame in which you have to pay back the loan. You're not even really required to make interest-only payments each month if you don't want to. Now, of course, the interest is going to accrue, the outstanding line that's due or the balance is going to continue to increase, which could put you at risk of getting into a margin call. But at the very least, you can make interest-only payments until perpetuity, die with the line of credit outstanding, and you being a smarter person when it comes to taxes, what happens to that brokerage account when I die and it goes to my estate or goes to a beneficiary? There's a step up in basis.
Right. Yeah. We get that wonderful step up in basis at the end of life from a tax perspective. This is like just like a great, like, hallelujah moment. At least if you're a tax guy. Most people may not say hallelujah, but tax guy, absolutely. Hallelujah on this moment. Yeah.
Right. And so, and then from that stance, the estate or the benefactor of the account has a couple options. They can liquidate some of the positions and pay off the outstanding line of credit. They can have the line of credit transferred to the new account registration and then continue to make payments back towards it. So there's just a bunch of flexibility with it, right? I mean, you touched on it. With a home equity line of credit, there's typically a 10, 12, 15 year before the balloon payments due, or you have to go back into underwriting to get the line reestablished. With a 401k loan, the longest I've ever seen it go out is about 5 to 6 years, and that's assuming that you don't leave the employer and then you're required to pay it back in full within 60 to 90 days. So in this case, it's very, very flexible, which I think offers a ton of opportunity for both high-performing professionals or, families who've done a very good job at saving and maybe they want to remodel their home, or for professionals who have a modest base salary but very strong uncapped incentive compensation, because there's a lot of variability to when those bonuses pay out. This could be an avenue for you to at least get the financing you need and then aggressively pay it down along the way, right? Another cool feature is that depending on how your portfolio is structured, you could actually use the dividends and interest that the portfolio is producing to make payments back towards the line of credit for you. So you already mentioned in a brokerage account, when you're receiving dividends and interest, it's already going to flow through to your 1040 tax form, right? Whether it's a qualified or non-qualified dividend, right? Or ordinary interest. So you're already being taxed on it. Why not go ahead and leverage it and utilize it to help pay back this obligation that you use to achieve a certain objective or goal?
Yeah, absolutely. Yeah. So there's a lot of tax considerations with this, and the intent here wouldn't be to flush all of them out, but maybe just to give the highlights of a few. I mean, you do have the possibility in which the interest being generated from this line of credit could be deductible to you. It would depend on what the intent or the use of the cash is. If it were to maybe be to acquire another property, like real estate wise, or maybe to secure an ownership interest in a business, we could take a business interest loan deduction on it. Or we could take, like a personal mortgage interest deduction. So those would be some possibilities. So even the cost of this loan isn't necessarily all cost to you. There's possibility for it to be deducted depending on what are we using this money for. But the other point, just so that this doesn't move past the audience, if you're not as familiar with this step up in cost basis and why using this equity line of credit could be more advantageous than just outright selling the position and then causing a taxable event, is that, if we are able to delay the sale of any of these stock or investment positions until the end of your life, there is no taxable event, then at that point in time, you get the step up in cost basis, and we've avoided paying any taxes. So that taxation could be ultimately unnecessary, and this could be a means by which we can still use the money without causing the taxation to happen. So just as much as, generally speaking, when it comes to income taxes, as you make income, you have to pay taxes on it. Well, not necessarily so. If we delay, the realization of that income far enough out, we may be able to avoid paying taxes altogether. And so this could be a means by which we make that delay without making the asset, worthless to you or unuseful because, you're not able to do anything with it. Well, you actually can. You can use this, to still put that money to work through other means. So I think, Mike, so there's a lot that I like about this. There is a cost, but look, you're not going to get anything in life without there being a cost associated with it. So obviously, if someone's going to give you the opportunity to basically tap the equity of the asset without selling it, there's going to be an expense there. And so you'll have to weigh in your own considerations and in your own advisory relationships whether or not that expense makes sense. But maybe just to play a little bit of devil's advocate on it. So, what would be the downside if somebody were to sell out of their positions and not use this? Like, how would that be disadvantageous or not as worthwhile as potentially going this direction?
So I would say that one is a loaded question, right? And I would say that it really stems on their overall psychological behavior when it comes to debt. Do they have a lot of aversion to debt, or are they at least open-minded to leveraging assets, right? I am of the camp that I would rather retain my assets that I've worked hard to save and build up in my hand for as long as possible before putting it on the balance sheet of someone else. And then I'm calculating, well, what's my recapture time frame? How long would it take me to replenish what I actually just spent out of these buckets on my own efforts, right? And in my mind, a lot of people may not have that ability to recapture the funds as quickly as possible. I also like to think from an entrepreneurial standpoint, right? If I'm looking to buy an investment property, why not take, a line of credit against my assets? And let's just say that I'm an aggressive investor that's been investing in the S&P 500 for the past, 10 years, 15 years. Well, the 10-year average on the S&P is over 10%. If my interest rate on this SBLOC is, let's just call it 6.25%, 6.5%, I am outpacing that hurdle rate pretty quickly, right? By over 3%. So would it behoove me to keep those funds in my pocket and have it continue to work in my favor, even if I'm still making 3.5% on the money net of interest rates? Well, if I'm going to go buy an investment property, yes, because now I still have my compounding asset in my brokerage account. I've turned around and bought an investment property that I'm likely going to be renting either short-term or long-term. Once it's cash flowing positive, maybe I even look at doing a cost segregation in the first year to recapture some of the depreciation up front. I can use that to pay back the securities-backed line of credit, or I can use some of the rental revenue to pay back the securities line of credit. And I've created this velocity of money concept. How can I use the same dollar multiple times without giving up control over it to achieve multiple goals?
Got it. Well, there's a lot to like about that. And what I do appreciate is just this identification of opportunity costs. And look, this would make sense as long as the underlying assets that we have are invested and expected to generate a return that's greater than the cost of the loan. And, we do have to recognize that one of the things is there's a difference between nominal interest on the loan versus the effective interest on the loan. And as I was saying a moment ago, if we are able to get a tax deduction on some of this interest, the full cost of this loan isn't captured in the nominal rate. We got to factor in the tax equivalent savings on the interest. And so maybe the cost of this loan really doesn't get to be all that much, depending on the tax benefit that might be had with the interest. But ultimately, if we're expecting more alpha, more investment return by keeping the money invested than repurposing it and putting it to other assets, especially if maybe it's assets that are going to depreciate in value, then we're more so to the interest cost of the loan. If there's a positive spread there, then yeah, this totally makes sense. So I might be honest, Mike, I don't know if I'm convinced that if I had a bond only portfolio that I would go ahead and do this, just because I'm paying 5 or 6% interest on the loan and only getting 4% back on my investments or what have you. But stock wise, this certainly seems promising, right?
So I would say that there's a time and place for everything, right? And as you mentioned, there's an opportunity cost to everything. And I think you have to look at the full scope of the picture, because I've seen folks who have leveraged a predominantly bond portfolio, right? And yes, it's maybe keeping pace with the interest or slightly lower the interest, but what they use the line of credit for is generating additional alpha on their balance sheet. So it offsets some of that cost, right? The bond portfolio is really just providing the foundational base of paying back at least the minimum interest only payments, if not more, right? The other thing to be mindful of is that I'm a firm believer that if you get a line of credit, let's just say that you have a portfolio value of $1 million and you get a line of credit for 60%, so $600,000. I'm of the camp that I try not to, or I coach clients not to use more than about 50 to 60% of the available line of credit at any given moment, because we want to leave enough of a wiggle room for variability if there's a market pullback, right? So that we don't fall victim to that margin call. Now, what's really neat about these products is that they can also provide what I like to refer to as a surge protector against sequence of return risk. So this transitions the scope of the conversation more so to like the retiree focus, right? If I'm a retiree and I'm taking a 4% distribution or 4% withdrawal from my investments, and I just have a mix of brokerage and retirement accounts, and I'm predominantly taking my distributions from my retirement account pre-required minimum distribution phase. Well, if the market's down 15% and I'm taking a 4% withdrawal, my portfolio just was reduced by 19%. Well, what if I take that 4% distribution from my line of credit? My portfolio value basically stays intact outside of market variability, right? I've sidestepped or at least prolonged or pushed off any sort of tax liability by leveraging the securities-backed line of credit. I have my need for the year to be able to live my life based on how the plan was designed. When the markets recover, that's when we can then pull funds out of the qualified or the retirement accounts to then pay the line of credit back. Does that make sense? So again, it's all about optionality, flexibility, and control over where you're pulling capital from to achieve the goals that you have without feeling like you can only take a traditional approach of selling your investments and realizing what I would call an increased effect of negative reduction of value.
Yeah. Now, what you're bringing up there, Mike, with the optionality, I think really is a big selling point in this, because the golden rule with any of our investments is we don't want to be selling them at an inopportune time. So if market values are down and we're basically getting a bad price for letting go of our shares, we may not be able to recover from that, or we're at least missing out on the opportunity for the rebound. So if we can still basically hold on to those positions, but get the cash out that we're wanting to get, and then position ourselves to have that rebound opportunity, which we presume, and I do think will likely happen, then again that's an ideal case study of why this would make a lot of sense. So I'm a big fan. I think this makes good sense for folks. Of course, you'll need to go and take it back with your own advisory council to decide whether or not this is something that's the right fit for your situation. At the end of the day, what we're doing here is we are leveraging, and so we're using debt to basically advance something from the future into today at a cost to you to do that advance. And debt makes a lot of sense from an economic and financial theory perspective, but it is something you have to ultimately be comfortable with individually, psychologically, as Mike was alluding to earlier. And so, the positive side of debt is that it can accelerate our goals even quicker if things go well. The downside to it is that it can flip you upside down and make your financial situation difficult if things don't go positively. And so you got to be comfortable with that risk. And so would want to avoid any over leverage, but generally I have a similar sentiment to you, Mike. Like, debt makes sense. Let's use it smartly, wisely. This seems like a great situation in which we could do that. And so we just encourage anyone who's interested in this, you certainly could reach out to Mike and his team to discuss it more. But, this is a concept that we have within the Financial Planners Network. So if folks are looking to discuss this with other advisors within the network, be sure to reach out and connect there. We're always adding new members to the network, and so we're looking to grow and do more and more connecting between, Catholic or, folks of really any faith. But, we are Catholic Financial Advisors Network. So if you're Catholic, we'd love working with you. If you're not Catholic, we'll still love you too. But, but we're looking to bring advisors and clients together. Mike, one thing that I would like maybe just to wrap up with is to give at least some further conversation to this is, if someone didn't want to tap their taxable brokerage account, or let's say they just don't even have one, maybe they have just a 401k or they've got IRA money or a Roth, could we just do a kind of a quick lightning of at least other ideas of things that we'll only discuss in a future call, but what are some other ways that we could tap those accounts?
Yeah, so I would say that it's a matter of first identifying, well, how liquid are the assets that I have today? So if you look at your bank account, checking, savings, I mean, that's probably going to be tier one liquidity, right? You can go to an ATM, stroke a check, swipe a debit card, and you have instant cash. Brokerage would be, in my mind, tier two, because it's going to take anywhere from about 48 to 72 business hours to raise the capital, right, by selling the investments and then transferring it to your bank account. Then you get into your qualified accounts, Roth, 401k, 403b, 457 plans. I would say those are more tier three in nature, just because there are the early withdrawal or early distribution penalties of 10% on most of those. For the pre-tax accounts, right, that's pretty much standard before age 59 and a half. On the Roth portion, you can get your principal back without the 10% early withdrawal penalty pre 59 and a half. If you tap into some of the gains, that's when you didn't get hit with that penalty. And then your equity in your home, in my mind, is tier four, because if you want to get access to the equity in your home, you have a couple options. One, you can sell the home, which might take 60, 90 days, right, to get from listing to an offer accepted to closing, maybe longer in today's housing market. Or you can set up a home equity line of credit, which is very similar to the securities-backed line of credit, except that it's against your house. So if I bought a home, and let's just say that the outstanding mortgage on it is $250,000, but it's valued at $800,000, I have equity in that property, right, to the tune of what, $550,000. Well, with a home equity line of credit, the bank will allow you to tap into a certain percentage. Typically, I believe it's going to be as high as about 85% of loan to value.
Yeah, I think that would make sense from my experience. I wouldn't imagine it'd be much more of an 80%, but I haven't pulled one out recently, just because most mortgages don't like to go above 80 unless you pick up PMI and have that
Correct.
expense or cost, right?
Correct. So, that is one avenue. You could do a home equity line of credit for the 401k if you are very heavy in retirement accounts, because that's where you've done most of your diligent, prudent savings efforts. Then, 401k loan isn't an awful path. It's just you're going to have less flexibility. And again, the rate that, or the interest that you're going to be paying is going to be associated with the prime rate, and it's either going to be a 1 or 2% margin on top of that. With the home equity line of credit, sometimes they're going to have introductory rates where it might be, prime plus 0 for the first 12 months and then prime plus 1 for the remainder, whether it's a 10-year, 12-year, 15-year, or 20-year, before it has to be paid back in full. Even if you haven't used it, that's just when the loan matures and you can no longer use it, have to go back through underwriting. So those would be the biggest ones. Other avenues would be if you own permanent life insurance and have cash value, you can always leverage that as well. So there is a liquidity effect there. So there are options. It's really just a matter of understanding and taking an audit of what assets do I own, and if I ever needed access to capital, what would be the path that I could take. I'm a firm believer that if you have equity in your home, there's really not a negative impact to having a home equity line of credit set up, even if you never use it, right? Yeah. More often than not, if you're going to have a home renovation and you don't want to use your savings, home equity line of credit's a great option. If you're looking to inject capital into a startup business, home equity line of credit, securities-backed line of credit. If you're looking for a buffer between to be able to offset secrets of return risk in retirement, home equity line of credit, securities-backed line of credit, cash value line of credit, like these are all available options. It really just comes down to, does it fit within your plan? Does the cost to gain access to the capital, is it higher or less than the expected growth rate on your investments that you're making or that you own? And then also, can you psychologically stomach the ebbs and flows of leveraging your assets? And that's where I think partnering with a trusted financial advisor that truly understands your goals and you as an individual or your family can really be beneficial, because I think our biggest positive impact that we can offer is more of the behavioral management side of things.
Yeah, absolutely. I mean, we're there on any number of levels, actually helping our clients to nudge things along, which is always rather fascinating to me because many of my clients are very successful. They've accomplished themselves. They're in high paying careers and are, they manage their money well and they're able to save. But we all have our own hangups, and sometimes you just need that third party person to speak to something and kind of nudge you along to do something that you might not be as inclined to do. And that really can be the difference maker between getting something accomplished versus not getting something accomplished. And so one of the great ways in which we work as their advisors is just to be that other set of eyes on their situation and give some, hopefully, objectivity, as we like to call it, in their finances. Right. One comment that I love everything that you had to say there between all the different options. And folks, some of this is through loans in terms of accounts that could be tapped, like a HELOC on the house or maybe a 401k loan. Other times we're just talking about outright distributing the money, and we're kind of we're not maintaining the investment. We're just pulling money out of the investment account and back to cash. Perhaps we do that with like a Roth IRA. A 457 doesn't have any 10% distribution penalties. So if that's something that you would happen to have available to your account, and some people do have it available. Sometimes they don't. It's a different account from a 401k, 403b, a TSP. What's a nice perk of a 457 is that you'll still likely have taxable income off of it. Most of those are pre-tax. Sometimes you'll see a Roth a version of a 457, but they at least don't have a 10% premature distribution penalty. So, if we're kind of wanting to scale things as to what would be a good account maybe to tap, I like to talk to my clients about Roth IRAs normally, and then 457s because they have, they have that nice perk. But Mike, thanks so much for being on the show today and just chatting and giving more direction. This certainly isn't a recommendation, folks, for this securities-backed line of credit. Just wanting to provide good education. If hopefully you found it valuable and worthwhile and something that you could put to use in your own finances. If you're not working with a financial advisor though already, consider reaching out to Mike, or consider reaching out to one of the advisors within the Catholic Financial Planners Network. We'd love to hear from you and be of service. So Mike, any closing thoughts on this matter?
No, the only thing I would add is that, I think we as a group at Catholic Financial Planner Network have a great group of advisors nationally, and as you mentioned, the community is continuing to grow and expand. So if you're an advisor and you listen to this and you're interested in potentially joining, absolutely reach out and inquire. We'd be happy to chat with you. Or the other side of that is, if you're a family and individual business owner looking to work with a Catholic-focused advisor, then definitely go to our website and check out our list of advisors and see if there's one that fits with what you're looking for.
Awesome. Well, Mike, thanks so much for being on the show again. It's always a blast when you're on. Have lots to share and say. Definitely an awesome time together. So thanks again for being here.
Thanks for having me.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by PAS, Guardian, or Genesis Wealth Planning, LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Michael Acosta is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Genesis Wealth Planning, LLC is not an affiliate or subsidiary of PAS or Guardian. CA insurance license number 0M50974, 9007420.2, expiry 0828.